Everyone knows you negotiate the price. That's the first rule. That's what your dad told you. What every car-buying forum repeats. What every How to Get a Deal article leads with. Know the invoice price. Research the market value. Walk away if they don't budge. Good advice. Solid, correct, well-intentioned advice. It is also almost completely beside the point if you don't understand what happens in the next 40 minutes after you shake the salesman's hand. Because the moment that handshake happens, you've finished the easy part. The part the dealership actively wants you to focus on. The part where they let you win a little, so you feel good walking into the next room. They are very deliberate about this, by the way. The win in the showroom is a feature, not a concession. You feel the momentum of a deal going your way. You feel the satisfaction of having negotiated. Your guard is lower than when you walked in. You've invested hours of your day. You are committed. And the next room is where the real transaction happens. That room has a different person in it. A quieter room. More paperwork. Friendlier lighting. A bottle of water on the desk sometimes. And the highest paid employee in the entire building sitting across from you, holding a pen. The finance office. Here's the number that should have been in every car-buying guide you ever read. The average dealer financing markup in the United States, the difference between the interest rate the bank actually approves and the rate the dealership presents to you, is 2.5%. On a $35,000 vehicle financed over 60 months, that markup generates between $2,700 and $3,200 in profit for the dealership, not the bank, not you. You will never see that number anywhere in your paperwork. There is no line called dealer margin on your loan. It's absorbed silently into your interest rate, and it will extract money from you every single month for the next 5 years. And you got $800 off the sticker price. So you're probably feeling pretty good. My attorney, a meticulous man who reads every word I write with the intensity of someone who charges by the sentence, would like me to clarify that what follows is educational content and does not constitute financial advice. He is right, and I paid him to be right. He also suggested I soften the next section. I told him I'd think about it. I did not think about it. Let me explain the mechanism. When you sit down in the finance office and agree to finance through the dealership, they submit your application to a lender, a bank, a credit union, a financing arm. The lender reviews your credit score, your income, your debt-to-income ratio, all the things that actually determine your risk as a borrower, and comes back with an approval. That approval includes a buy rate, the rate at which the lender will extend credit to the dealership. Let's say your profile earns you a buy rate of 4.5%. That's what your financial history, your credit, your actual risk profile is worth in the market. The dealership is then legally permitted, and has been since the 1950s, to mark that rate up before they show it to you. They might show you 6.9, 7, 7.5. The spread between 4.5% and 7% is called dealer reserve, and it belongs to the dealership. This is not a glitch in the system. This is not a loophole. This is the deliberate, designed, long-established architecture of how dealership financing has operated for 7 decades. The Consumer Financial Protection Bureau has pushed to limit it. The Federal Trade Commission has scrutinized it. The auto dealer lobby, one of the most effective and well-funded in Washington, has successfully protected it. The markup is legal. It is largely unregulated. And it does not appear anywhere in the documents you sign. Let me give you a concrete number to make this real. The difference between a 4.5% loan and a 7% loan on a $35,000 vehicle financed over 60 months is approximately $82 per month. $82. Across 60 months, that's $4,920 in additional interest. You never negotiated that number. You were never shown that number. You were handed a monthly payment, and the rate was simply part of the document. I've watched this from the other side of the desk for years. And here's what you need to understand about the person sitting across from you in that room. The finance manager is the best closer in the building. He is not closing you on a car. The car is already sold. He is closing you on a payment. That word, payment, is the hinge everything swings on. The moment the conversation moves from the total cost of this vehicle to your monthly payment, the dealership has tactically repositioned. You're no longer evaluating a purchase. You're evaluating a number that sounds manageable. And inside that manageable number, several layers of margin are quietly at work. The finance manager knows this. He has run this conversation hundreds of times. You are running it once. That asymmetry of experience is worth as much as any structural advantage in the room. Let me introduce you to Sarah, 29 years old, first-time buyer, $60,000 a year in income, good credit, actually a credit score good enough to qualify for 4.2% financing. She spent 3 weeks researching. She read every forum. She knew the invoice price. She had a printout. She negotiated $800 off sticker. She walked into that dealership prepared. She sat down in the finance office. The finance manager was friendly, patient. He explained things clearly. He walked her through each product as a form of protection, because she was a first-time buyer, because new cars depreciate quickly, because things break. Every product was framed as something a responsible person would want. Every cost was expressed monthly. 40 minutes later, she signed for gap insurance at $900, an extended warranty at $2,400, and a loan at 6.9%. She qualified for 4.2. Total overpayment across the financing markup and the add-on products, $4,100. She told me she felt good about the deal. I want you to sit with that for a moment. She felt good because the finance manager did his job well. He presented each product as a form of protection. He folded the costs into a monthly payment so seamlessly that no single number felt alarming. The warranty was $42 more per month. The gap was $22 more. The rate difference was never broken out as a dollar figure. It was just the rate, $4,100. And she drove home feeling like she'd handled it. Sarah's not unusual. Sarah is the median outcome of a well-designed process. Let's talk about the add-on products, because the interest rate markup is only one of 2 extraction mechanisms in that room. Gap insurance, extended warranties, paint protection packages, fabric protection, tire and wheel coverage. Sometimes a thing called key replacement or dent protection. Occasionally something called a vehicle etch product, which is literally an identification number etched into your window glass for $300. Every one of these products exists in the finance office because each carries a margin of 80 to 300%. Gap insurance through a dealership typically costs between $600 and $1,200, added to your loan, accruing interest over the full loan term. The identical coverage, the same function, the same protection, added to your existing auto insurance policy, costs between $20 and $40 per year. $20 to $40 per year versus $600 to $1,200, financed, same coverage, different room. Extended warranties carry similarly engineered margins. The dealership purchases them from a warranty administrator at a wholesale rate and marks them up before presenting the total to you. Industry data suggests that on many warranty products, The dealer markup runs between 40 and 100% above the administrator's cost. To be fair, extended warranties can have genuine value depending on the vehicle, the reliability tier, and your specific situation. The function is legitimate, but the math on extended warranties, evaluated across millions of buyers, has historically favored the seller significantly more than the buyer. And you are being asked to evaluate that math in a small room, with paperwork in front of you, after hours of a car buying process. That is not the optimal moment for financial analysis. Paint protection packages frequently involve a can of product and 20 minutes of application time. The charge? Somewhere between $300 and $1,500. And none of this is presented as individual line items with individual decisions attached. It's presented as a package, a bundle, a monthly number, because monthly numbers compress large costs into something that registers as manageable. $22 a month sounds reasonable. Over 60 months, that's $1,320 plus interest. The number didn't change. The framing did. Entirely. So here is what actually changes the outcome. Not more research on the car, not knowing the invoice to the dollar, not a better negotiating strategy in the showroom. What changes the outcome is one specific action you take before you walk into the dealership. Step 1. Get a pre-approval from your own bank or credit union. Not a rate estimate, not a quote. An actual pre-approval in writing with a rate attached. This takes between 20 and 45 minutes online. Most banks offer it. Most credit unions, which historically offer more competitive rates than banks on auto loans, offer it. The process is the same as a loan application, and you'll get a number in writing. Worth noting here, credit unions, specifically, have consistently offered lower auto loan rates than traditional banks in national surveys. The spread can be 0.5% to a full percent, depending on the institution and your profile. If you are not a credit union member, many allow you to join for a nominal fee. The math on that membership fee versus a year of loan interest is not a complicated calculation. Bring that pre-approval number with you. When you sit down in the finance office, say this: "I have financing at 4.8%. Can you beat it?" 3 things happen when you say that sentence. First, the dynamic in the room shifts completely. You are no longer a buyer who needs financing. You are a buyer who already has financing, giving the dealership an opportunity to earn your business. The informational asymmetry that the entire system depends on has partially collapsed. Second, sometimes they can beat it. Dealerships have relationships with multiple lenders and occasionally access buy rates lower than what your bank offered for your specific profile. If they can beat it legitimately, you take their rate, knowing it's genuinely competitive because you have a real comparison point. That's a win. Third, and most importantly, you have eliminated the invisible markup. Because any rate they offer can now be evaluated against a baseline. There is no fog. You know what the market thinks your credit is worth. And a finance manager who knows you know is a fundamentally different conversation partner than one who is operating on an information gap. Step 2. Evaluate every add-on product individually. The finance manager will present you with a menu. Often, literally, a printed sheet with package options. His goal is to have you evaluate everything together as a single monthly number. Resist that framing. Ask about each product separately. Ask for the total cost, not the monthly addition. Write it down if that helps you stay in the actual numbers. Then say you need to think about each one, for each one, individually. This slows the room. That is the point. The finance office runs efficiently on momentum. Decisions made quickly, one after another, feel connected to the purchase you've already committed to. Separated out, each product has to justify itself independently. For gap insurance specifically, if you're financing more than your car is worth, which is common in the first year of a new vehicle loan, gap coverage has real value. The function is legitimate. But call your auto insurer. Add it to your policy, $20 to $40 per year. The decision takes one phone call and 5 minutes. For extended warranties, ask for the actual contract terms before agreeing to anything. What is excluded? What is the deductible per claim? What is the administrative process for getting a repair covered? Ask those questions specifically, in writing if possible. Then, outside of that room, without a closer present, evaluate whether the total cost makes sense for that specific vehicle's reliability profile. You can always purchase an extended warranty later, sometimes directly from the manufacturer, often at a lower price than the dealership's finance office offers. Step 3. Track the total, not the monthly. Before you sign any financing documents, ask for the total cost of the loan. Principal plus total interest over the full loan term. That single number is the actual cost of your financing decision. Finance managers rarely volunteer this figure. Ask for it directly. Write it down. Then compare it to what your pre-approval would cost over the same term. That calculation, right there, is worth every minute of the time it took to get a pre-approval. Step 4, and this one costs nothing. Remember what room you're in. The showroom is where you buy a car. The finance office is where you buy a loan, an insurance product, and a warranty. These are separate transactions with separate economics. Treat them as separate decisions, not as one continuous purchase experience, because the design of the process actively encourages you to blur them together. The blur is expensive. Here's the thing I want you to actually carry with you. The finance office is not a room full of people acting outside the rules. The finance manager is skilled, well-trained, and doing exactly what the system designed him to do. He is not unusual. He is the intended output of a business model built around the information gap between a professional who runs these transactions every single day and a buyer who does this once every 5 to 7 years. The system isn't broken. It's working exactly as designed, and the data reflects this. In recent years, the National Automobile Dealers Association reported finance and insurance revenue per retail vehicle sold exceeding $1,700 in average gross profit per car. Industry average. Many dealerships run considerably higher, particularly in volume dealerships that have optimized the finance office process over years of data. Some run closer to $3,000, some higher. For context, the gross profit on the vehicle itself, the sticker price, the invoice, the number you spent weeks researching and negotiating, has historically averaged under $1,000 at many dealerships. Let me say that again more plainly. The 40 minutes you didn't prepare for is sometimes worth more to the dealership than the car you spent months preparing to buy. That is not an accident. That is architecture. And it has been architecture since before most of the people reading this were born. The dealer reserve system, the add-on product playbook, the training protocols for finance managers, these are not recent innovations. They are a mature, refined, legally protected profit structure that has survived decades of regulatory scrutiny because it operates entirely within the law and, until recently, entirely outside public awareness. Now, the golden rule: negotiate the price. It matters. Know your invoice. Know your market value. Know what you're willing to pay. That preparation is real, and it has real impact. In the showroom, the finance office is a different room with a different game running inside it, and almost nobody explains that to you before you walk in. The car buying guides cover the showroom in great detail. The finance office gets a paragraph, maybe two. Usually something vague about watching out for add-ons. That advice is technically correct and practically insufficient, because the person sitting across that desk is the best closer in the building, and he has been expecting you since you shook the salesman's hand. What he hasn't been expecting, on the days it happens, is a buyer who already has a rate in writing. That piece of paper changes the entire room. 30 minutes at your bank or credit union website. One pre-approval. One number in writing. That is the most valuable thing you can bring into a car dealership. More valuable than hours of invoice research. More valuable than knowing every trim level and competitor price. More valuable than the confidence of someone who's read every forum and printed every pricing guide. Because it's the only thing that speaks the language the finance office actually runs on. The showroom speaks the language of the deal. The finance office speaks the language of the rate. Show up in the finance office speaking that language, and you have already changed the fundamental structure of the conversation. You're going to buy a car eventually. Maybe you already have one financed right now. If you do, pull up your loan documents tonight. Find your interest rate. Then spend 15 minutes checking what your credit profile would qualify for at a credit union or bank today. The difference between those two numbers, multiplied across your remaining loan term, is a real figure. Sometimes that figure is worth a refinance conversation. Refinancing an auto loan takes less time than most people assume, and depending on how early you are in your loan term, the interest savings can be substantial. Not always. Run the math specifically for your remaining balance and months. But run it. Sometimes that calculation just tells you what the last finance office visit cost. Either way, now you know. And the conversation nobody had with you before you walked in? You just had it. There's another part of this I didn't cover today. What happens before the dealership, when you're deciding how to structure the purchase itself, whether to buy or lease, how the length of the loan term interacts with depreciation, what your actual total cost of ownership looks like across 5 years, not just the monthly payment. That decision shapes everything that follows, including what leverage you have in both rooms. I'll get into that next.